Folks, buying your first home is one of the biggest financial decisions you will ever make. It's an exciting time. Painting walls, setting up your new life. But before you get to the fun part, you have to tackle the mortgage. This is where a lot of people get nervous. And for good reason. Choosing the right mortgage lender is not just a small detail. It is the foundation of your home buying journey. The right partner can make the process smooth and understandable, while the wrong one can turn your dream into a stressful, confusing nightmare. This decision will affect your finances for decades to come. So it's crucial to get it right from the very beginning. The goal here is simple. Find a mortgage that you can actually afford. Monthly payment that fits comfortably within your budget, not one that keeps you up at night. You also want stable loan terms, meaning you know exactly what you're getting into without any scary surprises down the road. And finally, you deserve a smooth closing process. The closing is the final step where you sign the papers and get the keys. A good lender makes sure this day is a celebration, not a chaotic mess of last-minute problems and unexpected fees. Your lender is more than just a bank. They are your guide through this complex world of home financing. Many first-time buyers are filled with fear, and that's completely normal. You might be worried about getting rejected for a loan. You might be scared of hidden costs that could drain your savings account. Maybe you're anxious about making a mistake that will haunt you for the next 30 years. These fears often come from a lack of clear information. The mortgage industry can seem like it has its own secret language, full of jargon designed to confuse you, but I'm here to tell you that it doesn't have to be that way. You can take control of this process and make smart, confident choices for your family's future. This guide is designed to cut through all that noise and give you a clear, step-by-step plan. We will break down everything you need to know in simple, plain English. You won't find complicated financial jargon here, just practical advice and real-world examples. We're going to give you the tools to face this process head-on, reduce your risks, and turn those feelings of fear into feelings of empowerment. By the end, you'll have a checklist you can use to compare lenders and choose the one that is truly the best fit for you, your budget, and your brand new home. So, what can you expect from this guide? Think of it as your personal roadmap to getting a mortgage. We are going to walk through this journey together, one step at a time, so you never feel lost or overwhelmed. We'll start by helping you understand the different types of home loans out there. Fixed-rate loans where your payment stays the same. Adjustable rate loans where it can change. We'll also cover government-backed options like FHA loans, VA loans. Understanding these options is the first step to finding a loan that works for you, not against you. Next, we will get into the nitty-gritty of preparing your finances. Before you even talk to a lender, there are some things you need to do to get your house in order. We'll show you how to check your credit score and what you can do to improve it if needed. We will also give you a list of all the documents you'll need to gather: pay stubs, bank statements. This preparation phase is critical. When you walk into a lender's office prepared and organized, you show them you are a serious, responsible borrower. This sets you up for success and can even help you get a better deal on your loan. Once you're prepared, it's time to start shopping for a lender. This is where things get really interesting. We'll teach you exactly how to compare different lenders. It's not just about finding the lowest interest rate. Fees, customer service, special programs for first-time buyers. We will give you a list of key questions to ask every single lender you speak with. This will help you see past the slick sales pitches and understand the true cost of each loan offer. You'll learn how to spot red flags and avoid lenders who don't have your best interests at heart. Finally, we will wrap it all up with a simple, actionable checklist. This checklist will be your final tool to make sure you've covered all your bases before you sign on the dotted line. Getting pre-approved. Reading the fine print on your closing documents. The goal is to empower you to make this decision with complete confidence. Buying your first home should be a joyful milestone. By following this guide, you can eliminate the guesswork and avoid costly mistakes, and confidently choose a mortgage lender who will help you achieve your dream of homeownership. All right, let's dive into the different kinds of mortgages you'll come across. Think of this as learning the basic models of cars before you go to the dealership. You wouldn't buy a car without knowing if you need a truck or a sedan, and the same logic applies here. The main types you'll hear about are conventional loans and government-backed loans. A conventional loan is a mortgage that is not insured or guaranteed by the federal government. These are the most common type of loan, but they often have stricter requirements. Government-backed loans like FHA, VA, and USDA loans are insured by a government agency. This insurance protects the lender if you can't make your payments, which often makes it easier for borrowers to qualify. We'll get into the details of each of these a little later, but it's important to know the big picture first. Within these categories, you'll also have to choose between a fixed-rate mortgage and an adjustable-rate mortgage, or ARM. A fixed-rate mortgage is exactly what it sounds like. The interest rate is locked in for the entire life of the loan. Your principal and interest payment will never change. An ARM is different. The interest rate is fixed for an initial period, say 5 years or 7 years, and after that, it can go up or down based on market conditions. Each one has its own set of pros and cons, which we will break down so you can see which one aligns with your financial plan. The loan you choose has a massive impact on your monthly budget and the total amount you'll pay over the years. It's not just about qualifying for a loan, it's about finding the right loan for your specific situation. For example, a first-time buyer with a smaller down payment might find that an FHA loan is the perfect fit. A military veteran will absolutely want to look into a VA loan, which is one of the best loan programs out there. Someone with a great credit score and a solid down payment might get the best deal with a conventional loan. Understanding these basic categories is your first step toward making a smart, informed decision. Don't let the alphabet soup of FHA, VA, USDA, and ARM scare you. We're going to demystify all of it. The goal is for you to feel confident when you talk to a lender, able to ask the right questions because you understand the landscape. This knowledge gives you power. It prevents you from being pushed into a loan product that benefits the lender more than it benefits you. By the end of this act, you'll have a clear grasp of your options and be able to identify which one or two loan types are the best starting point for your home search. This is the foundation upon which your entire home buying journey will be built. So let's make sure it's a strong one. Before we compare different loans, we need to speak the language. The mortgage world is filled with jargon, but it's not as complicated as it seems. Let's break down the most important terms you'll encounter. First up is the interest rate. This is the percentage the lender charges you for borrowing the money. It's a huge factor in your monthly payment. Next is the APR, or annual percentage rate. The APR includes the interest rate plus other costs, lender fees, and mortgage insurance. Because it includes more than just the interest, the APR gives you a more complete picture of the loan's true cost. Always compare APRs when you're shopping for a loan, not just the interest rates. Now let's talk about the money you bring to the table. The down payment is the portion of the home's purchase price that you pay up front. It's your initial investment in the home. Many people think you need 20%, but that's not always true. Some loans allow for as little as 3% down. If you put down less than 20% on most loans, you'll likely have to pay PMI, or private mortgage insurance. This is insurance that protects the lender in case you stop making payments. It's an extra cost added to your monthly payment, so it's important to understand how it works and when you can get rid of it later on. You will also hear about points, or discount points. These are fees you can pay the lender at closing in exchange for a lower interest rate. 1 point typically costs 1% of your loan amount. Paying for points can save you money over the long run, but it means you need more cash up front. Then there are closing costs. These are the fees you pay to finalize the mortgage and transfer ownership of the home. They can include things like appraisal fees, title insurance, and loan origination fees. Closing costs typically range from 2% to 5% of your loan amount, so it's a significant expense you need to budget for. Finally, there's the loan term. This is simply the length of time you have to repay the loan. The most common loan terms are 15 years and 30 years. A 30-year loan will have lower monthly payments, but you'll pay a lot more in interest over the life of the loan. A 15-year loan comes with higher monthly payments, but you'll build equity faster and pay far less in total interest, saving you a ton of money. Understanding these key terms is non-negotiable. They are the numbers that determine how much your home will truly cost you, both today and for many years to come. Knowing what they mean allows you to compare offers accurately and confidently. Now let's look closer at one of the biggest choices you'll make. A fixed-rate mortgage versus an adjustable-rate mortgage, or ARM. Fixed-rate mortgage, predictability. Your interest rate is locked in for the entire loan term, 15 years or 30 years. Your monthly principal and interest payment will never change. That stability is incredibly valuable for first-time buyers. You can budget with confidence. Largest monthly expense set in stone. No matter what happens with the economy or rates, your payment stays the same. On the other side, the adjustable rate mortgage, or ARM. An ARM typically starts with a lower interest rate for an initial period, 3 years, 5 years, 7 years, or 10 years. This is the introductory period. For example, a 5/1 ARM, fixed for the first 5 years. After that, the adjustable part kicks in. Your rate will change periodically, usually once a year, based on a financial index. Your monthly payment could go up or down. The main appeal is the initial lower payment. Might help you qualify or free up cash. Who should consider an ARM? Someone who won't stay long-term. If you plan to sell before the introductory period ends, you can avoid adjustments. However, there is risk involved. If plans change and you stay longer, payments could rise significantly if rates climb. Those payment shocks can be a major financial strain. For most first-time buyers, a fixed-rate mortgage is the safer choice. The peace of mind from a predictable payment is priceless. Scenario: imagine 2 loans for $300,000, 30-year fixed at 6.5%, about $1,900 a month. A 5/1 ARM starting at 5.5%, about $700 a month. That extra $200 a month seems nice, but after 5 years, if rates jump, the ARM could shoot past $2,200. That's a huge increase to absorb. Unless you have a specific plan and high risk tolerance, stick with a fixed rate loan.